If you adjust that for inflation, in 14 years, the housing payment in real dollars got $657 cheaper, not more expensive. Well, everybody is worried that housing prices are too high. I would argue that they're still pretty cheap. There's so much talk about how much prices have increased with real estate prices around the nation. Many people are worried that there's a bubble. It's probably the most common question we get, are we in a bubble? If so, when's it going to pop? Because we all remember just 12, 13 years ago what happened during the Great Recession, right? And that was the worst economy in about 7 decades since the Great Depression, or really 8 decades, I guess, depending on how you count. Everybody's fearful that that's going to happen again, and rightly so. But the circumstances today are very, very different than they were then. There are many ways we can evaluate the value of real estate and the value of everything else, as a matter of fact. But one of the really important ways is by comparing things to the value of other things. And if we compare that value to many other things, we get a really good sense of whether it's expensive or it's cheap, right? There were nearly 400 metropolitan statistical areas in the US, or MSAs. We hear that expression a lot, MSAs, metropolitan statistical areas. And there are. In a country as large and diverse as the United States, there's no such thing as a national real estate market. And when we hear these talking heads in the media, we read about them in various publications, they talk about the housing market or the real estate market. And, I can't figure out where that is. I don't know if the housing market's in New York or Washington, D.C., or Boston or Miami or L.A. or Portland or Memphis or Little Rock or Dallas or Houston or Palm Beach, Florida, where I live. There's no such thing as a national real estate market in a country this big. There are just a lot of little local markets. But to simplify things, you can categorize all real estate markets, not only all around the country, but all around the world, into 3 basic types. And the 3 types are linear markets, cyclical markets, and hybrid markets. So we'll kind of talk about that, and then we'll talk about this comparison aspect as well. So it's all about the measuring stick. And there are many ways to measure things. And right now, the media is measuring things in just one way. When they talk about real estate prices, they're only comparing them to one thing. First off, they're only talking about the price of the property, not the monthly payment on the property. And that's a huge mistake. So we'll get into that one. But they're also comparing the price of real estate only to dollars. Now, guess what, folks? Nobody told you that as you've been saving money to invest in whatever you want to invest in over the last 5, 10, or 20 years, nobody forced you to keep your money in dollars, although most of you did. Okay, so mostly that's the way people measure things. But I'm here to talk about some alternative ways to measure things and alternative ways to compare the price of real estate. And then in part 2, the monthly payment on real estate, which is really more important than the price, because very few people buy on a price. Most people buy on a payment. So we'll get into that too. Okay, so a tale of 3 markets. As I was talking about before, there are 3 types of real estate markets in the country or in the entire world. There are linear markets. These markets are stable and profitable. They are my favorite types of real estate markets. And then there are cyclical markets. These are like a roller coaster. They go up, they have glorious highs, they have really ugly lows. And if you're looking at a graph or a chart, that chart looks like a roller coaster, ups and downs. Now, the funny thing is, most of the markets in the country and in the world that get all the attention are the cyclical markets. There aren't that many of them, but they get all the news media attention. Why is that? Because they're newsworthy. They're not boring. Linear markets are boring. They just chug along and kind of go up slowly. Okay, they have little ups and downs, but they're not very pronounced. Whereas cyclical markets, oh, wow, there's news. Prices are going up like crazy. Prices are crashing. That's newsworthy, right? There's an old saying in the news media, if it bleeds, it leads. The media loves sensationalism. So they tend to ignore all of these great linear markets. And then the third one is the hybrid market. As the name would imply, it's in between the two. So just understand that those are the three types of markets. I always ask this question on my podcast, The Creating Wealth Show, and I always say, compared to what? And this is a really important question. In fact, I say it so much, my listeners have dubbed it the Jason Hartman question, even though I did not invent the question. So, compared to what? That is the $1,000,000 question we need to be asking ourselves. Compared to what? There's an old saying in economics: the cure for high prices is high prices. What does that mean? Well, one interpretation of this famous saying is that when prices are high, demand will fall off and prices will come down. Okay, that's the simple, most basic rule of economics, is supply and demand. There's another saying, the corollary to it is the cure for low prices is low prices. If the prices are too low, the market's going to discover that, and they're going to start buying up all the widgets, all the houses, all the whatever, and the sellers of these items are going to raise the prices. And this is constantly going on as the market regulates itself through supply and demand. Now, as I talked about before, the most common thing I think on people's minds right now is, are we in a bubble? And if so, if we're in a bubble, when will the bubble pop? That is the question. Now, before we get into this comparison issue, I want to tell you about another thing. For the last 18 years, I've taught a concept I call packaged commodities investing. When we look at a house, we really need to consider whether it's a house, an apartment complex, and I've owned both, many of both, or whatever type of real estate deal we're looking at. We're buying two components. One component is the land, and the other component is the structure sitting on the land. And if it's a house or pretty much any structure, it's made of commodities that are traded worldwide, that are not indexed to any particular currency. They have intrinsic value. So if all the world's currencies went away tomorrow, and there was no such thing as a dollar, a yen, a euro, a peso, whatever, if those didn't exist, people could trade lumber, steel, petroleum products, glass, concrete, and all the other ingredients of a house without currency, without money, because these products have intrinsic value and they are the ingredients to a house. So when we think about a house, I want you to think of it as investing in commodities. Okay, we are really commodities investors more than we are real estate investors. And unlike commodities investors buying these commodities on the mercantile exchange, okay, we get to finance them for 3 decades with artificially cheap fixed rate debt that is tax deductible. We get all these tax advantages. When we package these commodities in the form of a house or an apartment building, they work differently. And it's a beautiful, beautiful thing. Okay, one commodity is lumber. And lumber prices, as probably everybody knows by now, have been skyrocketing. They've just been going through the roof. In fact, the price of lumber has put upward pressure on new home prices to the tune of $24,000 already, just due to the cost of lumber. Okay, this is one super important commodity. But a lot of these other commodity prices have gone through the roof as well. Just remember, one commodity that economists look at all the time is copper. And if you were to open up the walls of any property you own, you'd see a lot of copper wire in those walls, right? So all of these ingredients to a house are very important. So lumber, iron, steel, all these fabricated structural metal products, you can see the prices have just gone through the roof. Okay. Now, this is a funny meme. It's a picture of a couple having a romantic dinner. She's saying to him, "Take me somewhere expensive." They're at the lumber yard. And that meme really does sum it up. We're in this crazy market where these commodities have become super, super expensive. Now, this chart goes back over 100 years looking at home prices. We can see something really interesting here. We can see that from 1900 until the big boom in the economy with the baby boomers coming back from World War II and building houses and just experiencing a wonderful booming economy. When America had its love affair with the automobile, Detroit was booming. I mean, things were pretty darn great in the 50s. Okay. So we saw prices go up quite a bit. And then there was another big change that occurred. And that was in 1971 when Richard Nixon closed the gold window. He took the last step of severing the tie between gold, which has been considered real money for 5,000 years. And he completely disconnected gold from the dollar in 1971. And then we saw housing prices and inflation in general, broad inflation, not just housing prices, absolutely go through the roof. And for those of you listening to audio only, the chart we're looking at is a huge, huge upsurge in housing prices. And then, of course, during the Great Recession, we saw them come down a bit, and then we've seen them go up, up, up ever since. And I won't be able to go into all of these concepts today, but I just want to offer a free book that I have. It's just a mini book. It's totally free, no credit card or anything like that needed. It's at pandemicinvesting.com, and it's really relates to a lot of these topics of how to invest during a pandemic. The specifics of the mass migration that is going on, where people are relocating, wealth is being transferred, and a lot of these topics that we'll talk about today, but in much more detail. So that free book is at pandemicinvesting.com. One of the topics I talk about is called inflation-induced debt destruction. And this concept is a way that people really, really get rich with real estate, and they don't even know it. They're not even always aware of this because it happens so subtly behind the scenes. And basically, it works like this. People use 30-year fixed rate mortgages, and then as inflation comes along, it devalues that debt. So as real estate investors, we get to pay that debt back in cheaper dollars. Absolutely beautiful thing. It's the hidden wealth creator in real estate that most people don't even realize is happening. So there's a lot more about that in the book. Okay, this chart shows home prices versus the consumer price index. The consumer price index is important because it's the most widely used measure of inflation. Now, I think it's a lie. It's very understated. It doesn't reflect real inflation that is much higher, but it is the official measure of inflation. So let's just go with it. Let's just all know that it is understated, and there's a lot of stuff they're not telling you in the consumer price index because it's manipulated. But here, if we look at this, we see that the Case-Shiller Home Price Index, the most widely used index for home prices, largely keeps in step mostly with the Consumer Price Index, except it gets out of sync at times. But the problem is, this index only reports on 20 major metro areas, and 75% of those metro areas in the index are, guess what? Remember those three types of markets we talked about? Well, 75% of the 20 markets, in other words, 15 of them, are in cyclical markets, not linear markets. So it's very, very misleading. You really have to peel back the onion on this stuff and really, really slice and dice. And that's why you need experts. You need a team. I have way more detail on my podcast, on my YouTube channel. And this is what experts are for, people that live, eat, and breathe this stuff. We're here to help you with it, to understand it. But just giving you some outlines and ideas today. So we all have this rich uncle, and his name is Jerome Powell. He's the chairman of the Federal Reserve Board. This is the guy that controls the money supply. Okay. And just think about this: money, or really more accurately, currency. The dollar is not really money, it's currency. The yen, the euro, the peso, all these other currencies around the world, they're not really money. They're just a symbol of what they're supposed to be money, right? And so all of these things are basically controlled by governments and central banks. And just think about this: if you ask yourself this question, what makes anything in the world valuable, right? Anything. It could be an economic unit, it could be a personal relationship. What makes it valuable? Two basic things drive value for anything: scarcity and utility. Okay. So the scarcity and utility of lumber are driving up the prices of lumber, right? The scarcity and utility of your significant other make them the most valuable person in the world to you, right? The scarcity and utility of dollars dictate their value. Okay, well, guess what? Last year, the experts will tell you that since the beginning of the dollar, right, last year, between 20 and 35% of all dollars ever created were created last year. What does that do to the value of the dollar if there are so many additional dollars being created out of thin air? Well, naturally, it debases or devalues the value of the dollar. And that simply means inflation. Because what happens is you have a large supply of dollars going into the economy, chasing a limited supply of goods and services. Well, guess what? The sellers of the goods and services see this tidal wave of dollars coming at them. And what do they naturally do? They raise the price. They say, hey, I can't keep up with the demand, so I got to raise my prices. I got to raise my prices so I can pay my suppliers, so I can hire more people to keep up with the demand and fulfill the orders, so I can buy a new factory to manufacture more whatever we manufacture, right? That's what happens. That's how inflation happens. Okay, so let's compare home prices not to dollars. Let's compare them to gold. Now, why gold? Well, gold is the most common measuring stick. It's the one that's got the longest history of having intrinsic value for literally 5 millennia, 5,000 years of history. Now, I'm not a gold bug, I want to tell you that, but it is a measuring stick, and it's a very, very popular measuring stick. So in the year 2000, 21 years ago, it took 610 ounces of gold to buy the median price house. 610 ounces, you could buy the median price house. Okay. In 2010, after the Great Recession, as we were kind of, maybe it had bottomed out by then, in 2010, it only took 162 ounces of gold to buy the median price house. So the question is, did gold go up in price, or did the house go down in price? Well, I don't know. Gold in dollars 10 years earlier was $274 an ounce. By 2010, 10 years later, it was $1,373 an ounce. In dollars, the median price home in 2000 was $167,000. And in 2010, it was $223,000. I'm rounding off. Okay. So the question of what went up or down is, it's not exactly clear. But if we simply use one measuring stick, we are always going to wonder what is happening. That's why we need to use multiple measuring sticks to really understand the value of anything. Okay. What's going on today? Well, today, if you want to buy the median price house, it'll cost you 208 ounces of gold. So, compared to 21 years ago, the house today only costs 1/3 of what it used to. It's cheaper by 2/3. So, I want to ask you this: are houses cheap or expensive today? So look, if you compare it to gold, housing is cheaper. Okay. If you compare it to Bitcoin, housing is super cheap because Bitcoin in 2010, it doesn't go back much further than that. 773,000 Bitcoin to buy a house. Today, only 7.5 Bitcoin. Okay. So there's that. How about oil? Oil, it's about the same price. Hasn't changed much in 21 years. Same number of barrels of oil today as back then, approximately will buy you a house. How about rice, the most common food in the world? 2/3 of the world survives on rice. Well, in rice, houses are a little cheaper today, just a tad cheaper than before. How about in the Standard and Poor's, the S&P 500 index? Houses are a lot cheaper compared to the S&P today. Okay, it would have taken you 1,884 shares of the S&P in 2000 to buy a house. Today, it only takes you 898. Houses are cheaper. So the question here, the point of all of this is it cheap or is it expensive? That's what we've got to ask ourselves. How about comparing it to median income? Well, in median income, houses are a little bit more expensive than they were 21 years ago, but not nearly as expensive as people would think they are compared to income. Okay, how about in hours worked at minimum wage? In hours worked at minimum wage, most minimum wage people can't afford a house, sadly, but if you did use that as a metric, houses are pretty expensive compared to minimum wage, okay? But it's not about the price, it's about the payment. So let me just give you maybe one comparison on payment and we'll wrap it up. So here's the median house price's mortgage payment. Okay, here's the mortgage payment, not the price of the house. Okay, in hours worked at minimum wage. All right, so in minimum wage hours worked to afford the monthly payment, 21 years ago, we would have had to work 192 hours to afford the monthly payment. But today, at minimum wage, only 165 hours. The house has gotten cheaper. This is a very real world metric here. This is entirely realistic. How many hours do you have to work to afford the payment? And here's at the median income. You only have to work about half of the hours today at the median income to make your house payment. Houses are cheaper. So everybody keeps asking, when's the bubble going to pop? Why is it so expensive? Are you sure it's expensive? That's my question for you. What are you using as your measuring stick? What are you comparing it to? I'm just going to speed ahead a couple of slides. I want you to see this. In 2020, here's your mortgage payment last year. It's about $1,318 per month. And in 2006, before the last bubble burst, it was $1,532 a month. And guess what? If you adjust that for inflation, in 14 years, the housing payment in real dollars got $657 cheaper, not more expensive. Well, everybody is worried that housing prices are too high. I would argue that they're still pretty cheap. Listen, the bubble will get over frothy at some point and it will burst. It will not last forever. Nothing goes up indefinitely. But for right now, housing is still looking pretty affordable to me.